All right, today I'm going to give you 3 signs of a stock market price bottom. I want you to keep these 3 signs with you for the rest of eternity. Use these 3 techniques over and over and over again throughout your entire lifetime. Because if you do, you're going to have a chance to make a lot of money every single time the market bottoms out once you know these 3 signs. And you can even pass these 3 secrets down from generation to generation. That's how I know them. What's up? It's your buddy Chris Rowe. If you don't know me, you're about to. All right, how to spot a market bottom is a super hot topic right now because folks don't want to miss the stock market bottom and all of the perfect buying opportunities it presents if your timing is absolutely right. So the first thing that you have to remember always is the story will always show up in the price behavior before it shows up in the news. Stock market charts tell the true story, and the story shows up in the price of the Dow Jones, of the Nasdaq, of the S&P 500 before it shows up in the news. Whether it's a short-term price trend or a long-term price trend, after a strong downwards trend, stock prices then move up off their lows. But that rebound off those price lows happens long before the positive news once again dominates the media. So if you try to call bottom based on what you hear in the news, you're going to miss that buying opportunity every single time. The stock market started trading lower back in November of 2021, and I'm recording this at the beginning of March of 2022. So we've had 3 or 4 months of declining prices. Now, maybe you're a savvy market timer, or maybe you're just a ballsy market timer, but your logic tells you that, of course, the best time to buy is when there's the most fear, the most blood on the street, because the strongest fear leads to the strongest selling. And when people are the most negative, it must be when prices should be at their lowest point that they're ever going to go, right? Well, that's a dangerous game. It's called catching a falling dagger. You've got to know when to choose higher probability of outcome over perfect market timing. I know you want to buy that exact low because you've imagined so many times in your head how someone could have made 500% if they just would have bought at that absolute low and then sold at the absolute high. But it doesn't happen like that. You've got to care more about probability of success than trying to make it a perfect success. The more you try and make it the perfect win that you can brag about, the more you're lowering the odds of a positive outcome. So I'll put it to you simply. What's the likelihood that you're going to time something perfectly? I mean, just buying at the low and selling it at the high. The likelihood has got to be in the single digits as a percentage, right? Play it like that and you'll never make money. Here's how you change your focus away from perfect timing and toward higher probability of profits. You have to first know this one Wall Street secret, and then I'll give you the 3 signs of a market bottom. I'll give you the 3 secrets. But first, the one Wall Street secret that you've got to know, and you can take this one to the grave with you, and it'll change your life forever. Because once I understood this one little thing, everything changed for me, and I became the best market timer that I know of. So the secret. First, you have to understand there are only 3 basic bottom formations. You'll notice every market bottom has one of these 3 basic shapes. There's the double bottom, where the market bounces off of a low and then tests that same major low again before going higher. There's a triple bottom, which I think is self-explanatory, 1, 2, 3, and then it launches off. And then there's a reverse head and shoulders, which is a triple bottom, but of the 3 low price points in the triple bottom, the middle one is a bit lower than the first and the third one. The secret that most people fail to realize is that the first bottom in any style of stock market bottom happens because short sellers are covering, taking profits. That means you have these traders who have been betting on stocks going lower by selling shares first in an attempt to buy them back later at a lower price for a profit. And they were sitting pretty because indeed stocks did move lower and lower. And since those particular traders have sold stocks short, those traders were making more and more money as stocks moved lower and lower. And at some point, those bearish traders, they want to take their profits off the table. So they have to buy back those stocks to close out their bearish trades. So The first bottom is not made by bullish investors who've seen enough, who think prices have become so unreasonably low that they're just going to step in and buy. No way is a fund manager going to risk his career and step in front of a moving train, a tsunami of supply of shares with waves just of selling crashing over him. No way. It's the second low where you'll see that traditional bullish investor stepping in and buying once they know at what price those bearish investors think they should be taking their profits and buying their stock back. It's a lot safer to buy somewhere near or shortly after a second bottom has been formed and the new even low has been tested. So again, the first low isn't traditional buyers. It's short sellers taking their profits by buying back stock. The second low is when bullish investors step in and they're buying stock alongside of those bearish investors who are taking their profits around the same level. So what you have is two forces of demand now in the battle between supply and demand, but it's on the second and the third low. And now for the three signs of a stock market bottom. I told you I'd get to it. For the first sign, I'll start with the easy one. Horrible news, but no new lows. Sign number one is when you see just awful news coming out, yet the market doesn't seem to want to go any lower, despite news that you thought would absolutely rock the market. This is usually a sign that you're somewhere at least near a low. In fact, it's even often a sign that you might have hit the absolute low because stock traders start selling stocks in anticipation of a negative event happening at some point. The stock market declines as traders are selling, and they're selling as they're positioning themselves to profit off of other people who they're hoping will hopefully sell their stocks further down the timeline when they too realize how bad things have gotten. But here's the problem with that. Oftentimes, by the time the big negative event happens, everyone's already pretty well aware of it and its dangers. And so everyone who would be a seller at this point to push prices lower has already sold in preparation of that big event. So it became a self-fulfilling prophecy. Like a lot of things in the stock market are a self-fulfilling prophecy. You think something bad is going to happen, and then you sell so much stock that the supply of it all knocks prices down to where you believe they might go if the bad thing does happen. Well, then prices get beaten down to the bottom before the bad thing actually happens, and then there's really nobody left at that point to sell their stock because sellers have already sold in preparation, leaving no future sellers in existence. Only future buyers. So that's why you'll sometimes see bad news coming out and it doesn't even seem to knock prices any further down, no matter how damning the news is for the economy and for stocks. And oftentimes you'll see the stock market moving higher on horrible economic news, which is really a head scratcher for new investors. So the first one is horrible news, but no new lows. That's the first sign. And now for a more complex sign, but one that you've probably seen already, you might know about it already, it's the positive divergence. So a positive divergence can happen in many different ways and with many different indicators where the stock market makes a lower low or an even low, but whatever the indicator is makes a higher low. I'm talking about the RSI. It's called the Relative Strength Index, and it's often misconstrued with something else called relative strength. So don't make that mistake. Just call the RSI the RSI. Don't worry about what it stands for. The RSI and relative strength are two completely different things. So the RSI is a momentum indicator. It's typically found as a default setting on any price chart, and therefore one of the first indicators that people learn about. But then they dive into a whole bunch of other indicators, deep into technical analysis. Now they're studying 1,000 different indicators, trying to get even better. They're overloaded with squiggly lines. And the RSI is already perfect. It's highly, highly accurate. What you need to know is how to use it. At a stock market low, no matter what type of market low it is, remember I said it's always going to be one of three different types of market lows. So you have the double bottom, you have the triple bottom, and you have that reverse head and shoulders bottom where the middle bottom of the three is even lower than the first and second and last. No matter which type of market low it is, the RSI, you'll see lows in the stock market are matched with higher lows in the RSI. So a double bottom, the stock market makes two even lows. But if at the same time the RSI makes higher lows while moving above the 30 line, then there's a strong probability the market is making a bottom. You have the triple bottom, where the stock market makes three even lows. But if at the same time that RSI makes higher lows while moving above the 30 line, then there's a strong probability the market is making a bottom. And the reverse head and shoulders bottom. The stock market makes one low, bounces higher, but then breaks below that first low to make a second lower low if at the same time you notice the RSI is making higher lows while moving above that 30 line, there's a strong probability the market is making a bottom. So the third sign of a market bottom, and this is the granddaddy of all market indicators I'm bringing you today. It's the third, probably the most important sign of a market bottom. It's seen in an indicator called the New York Stock Exchange Bullish Percent Index, also known as the New York Stock Exchange BPI. This one isn't typically found at the top or the bottom of some price chart. This indicator is its own thing. It's found on its own screen. In fact, there's a web page that you can find it on that updates daily, and you can bookmark it right now. It's truemarketinsiders.com/BPI. Every time it makes a significant change, we'll add commentary below the indicator to explain what's happening to it. So you'll learn along the way. Be sure to check it because it's so important. You can also learn about it on a small webpage that I created at majorbottom.com. So here's the key sign of a market bottom. When the New York Stock Exchange BPI is below 30 and then reverses up to a column of X's, that's a major sign of a market bottom. It's an up column. So again, when the indicator is first below 30, the stage is set. If it's first below 30, and then that newest column, which is the column on the far right, when the most recent newest column on the far right flips to X's, it's game on for bullish investors. This indicator shows when supply or demand is in control of the market, and it shows us how much risk the stock market has to it. So those two things. When the reading is low and is flipped from a down column, which is a column of O's, back to a column of X's, that's when you take your bullish position right there. Okay, I'm going to level with you now. A stock market bottom is super emotionally charged time. It's a very scary time. It's a very confusing time. Having these key concepts at your disposal is helpful, but it's not enough. You have to recognize them and you have to use them. So watching this video isn't enough. You have to spend another 20 minutes staring at the RSI and the New York Stock Exchange BPI on your own. Do it after this video ends while it's still fresh in your mind. It's worth the time, trust me. Think of all the money that you'll save or make. Being able to time the market is really cool. It feels good and it can make us money. We can brag about it. It's the number one thing that people think about when it comes to the stock market is market timing, right? But I've got good news for you. Like I always say, timing the market or timing your stock is not what's most important. What's most important is what you invest in, not when you invest in it. I mean, I've given you 3 keys to spotting a market bottom, and I know that's going to change your life if you get good at mastering just those 3 signs. But think about this for a second. When the stock market is bottoming, thousands of stocks and lots of industry groups or sectors are all bottoming at the same time. It's what you decide to invest in that counts. Think of it this way. Would you rather try to capture nearly all of a 20% move higher, or would you rather capture just half of a 100% move higher? If you want to learn more about what to invest in, go back to my channel and watch my videos on sector investing. I have a question for you, and you can leave your answer in the comment section below. What other technical videos do you want to see from me? How can I help? Just tell me, what can I do to make you a more confident investor? Let me know. Please tell me so that I can help you and other people out there. Tell me in the comment section below, because I'm on a mission right now to change the world. I'm an advocate for individual investors. If you like what I've shown you here today, share this video, help your friends. They may thank you one day for helping them avoid bad market timing. Leave your answers as a comment in the comment section. Give me a thumbs up if you like this, and you can subscribe to my YouTube channel if you haven't already. And my handle on YouTube and my handle really on all social media platforms is Chris Rowe Trader. One word, that's Chris Rowe Trader, and I'm out.